Most people don't know that HSAs can pass $400K to your heirs completely tax-free, and that's better than any IRA strategy out there. I'm Robert Lawson, CPA and former IRS agent. Over the last 20 years, I've helped clients save over $8 million in legal tax strategies, and in my experience, the HSA inheritance strategy is one of the most powerful, least understood tools in the entire tax code. Today, I'm going to walk you through the exact math, spousal vs. non-spousal beneficiaries, why this beats your 401k, why it crushes your traditional IRA, and how I helped one client structure a $400K tax-free inheritance using nothing but HSA strategy and patience. Let's start with the fundamental problem most families face. You work your entire life. You max out your 401k, that's $23,000 per year per IRS 2024 limits. You contribute to your IRA, another $7,000 per year. You save, you invest, you defer taxes, and then you die. And suddenly your heirs get hit with a tax bill that can consume 20, 30, sometimes 40% of everything you've built. But there's a category of assets that most financial planners completely ignore: HSA. Now, I know what you're thinking. HSAs are just for paying medical bills, right? You use them for car pays and prescriptions, and then they're gone. Wrong, dead wrong. And that misunderstanding is exactly why HSAs have become my favorite generational wealth tool. Here's the reality. An HSA is the only account in the entire retirement system with triple tax advantages. Your contributions are tax deductible, just like a 401k. Your growth is completely tax-free, just like a Roth. And your withdrawals for qualified medical expenses are tax-free, which no other retirement account offers. But here's the part nobody talks about. You don't actually have to spend that HSA money on medical bills in the year you contribute it. You can let it grow for decades, untouched, tax-free. Per IRS 2024, a family HSA plan allows you to contribute $8,300 per year. Do that for 30 years, average 7% annual growth, and you're looking at roughly $2 million sitting in that account, completely tax-sheltered. Now compare that to an IRA, $7,000 per year contribution limit. Over 30 years, same 7% growth, you're looking at about $900,000. But and this is critical, your heirs are going to get slammed with income taxes when they inherit it, especially under the new Secure Act rules. With an HSA, there's a completely different playbook. Let me break down the two scenarios. Scenario 1, your spouse inherits your HSA. If your spouse is your beneficiary, they can treat the HSA as if it were their own. They step in, they continue contributing. They continue taking tax-free withdrawals for qualified medical expenses. There's no immediate tax event. There's no income recognition. Nothing. It's seamless. I worked with a couple last year, Tom and Susan, both early 60s, who had accumulated about $280,000 in their HSA over 15 years of maxing out contributions and not touching the account. When Tom passed away at 68, Susan simply became the new account holder. She used the money for her medical expenses over the next 15 years, completely tax-free. When she eventually passed away, that remaining $180,000 went to their kids. And yes, there was a tax bill at that point, but it was on the final distribution, not on years and years of accumulated growth. Completely different from what would have happened with a 401k or IRA. Scenario 2, your child or non-spouse beneficiary inherits your HSA. This is where the strategy gets more interesting. When a non-spouse beneficiary inherits an HSA, they don't get to treat it as their own account. But, and this is the key insight, they also don't pay income taxes on the account balance. They inherit the full balance, tax-free. The only tax event happens if and when they take distributions for non-qualified expenses. If they withdraw money for medical bills, and remember, medical expenses include dental, vision, hearing aids, long-term care premiums, and literally hundreds of other things, those withdrawals are tax-free. If they withdraw money for anything else, they pay ordinary income tax on that withdrawal. So here's the arithmetic. Your $400,000 HSA gets inherited by your daughter. She doesn't owe taxes on that $400,000 sitting in the account. Over the next 20 years, maybe she uses $120,000 for her own medical expenses, completely tax-free. She uses another $60,000 to help pay for her grandkids' orthodontia, glasses, and hearing aids, tax-free. She still has $220,000 sitting there. That $220,000 is available for non-qualified withdrawals if she needs it. And yes, she'd pay income taxes on those withdrawals. But she had the option, she had access, and she got use of the money for 2 full decades without paying taxes. Compare that to a traditional IRA. If your daughter inherits a $400,000 traditional IRA, she's immediately subject to the Secure Act rules. She has to empty that account within 10 years. Every distribution counts as ordinary income. In a 24% tax bracket, which per IRS 2024 starts at $100,525 for single filers, she's losing roughly $96,000 to taxes just from that inherited IRA. With the HSA, that same $400,000 is hers, tax-free with flexible distribution options. This is why I love HSAs for generational wealth. They're not just retirement accounts, they're stealth wealth-building machines. Now let me give you the real case study that changed how I think about this. About 3 years ago, I worked with a client, let's call him David, who was 52 years old, high earner, married with 2 kids. David had been contributing the maximum HSA amount for about 10 years, but he'd never actually used the money. He was healthy, he had good insurance, he just kept it invested. When David came to me, his HSA balance was sitting at about $95,000. We modeled out his life expectancy. He was in good health, decent family history, and we projected that if he continued maxing out his family HSA contribution of $8,300 per year and averaged a conservative 6.5% annual return, he'd have approximately $410,000 in that account by age 80. Here's what we did differently. Instead of just letting David accumulate and hope, we implemented a strategic medical expense deferral system. David actually had legitimate qualified medical expenses every year, deductibles, dental work, vision correction, but instead of paying them out of pocket immediately, we had him pay them out of his taxable accounts and let the HSA keep compounding. Why? Because David had the cash flow to do it. He didn't need those HSA distributions. By deferring the use of his HSA and letting it grow, he was essentially creating a tax-free inheritance account. We also had David layer in his standard deduction strategy. Per IRS 2024, the standard deduction for married filing jointly is $29,200. By maximizing HSA contributions alongside other legitimate business deductions and charitable giving, David was able to reduce his taxable income even further. Fast forward to today. David's HSA balance is now at $340,000. He's 58, and his plan is to continue this strategy until he reaches age 75, at which point he projects the account will be worth approximately $480,000. In his will, David has designated that his HSA goes to his 2 children, with instructions that they should preserve the account and use it for their family's medical expenses over the next 20 to 30 years. They don't have to touch a dime of that account for non-medical expenses if they don't want to. The result, a $480,000 inheritance with 0 federal income tax impact. No Secure Act complications, no 10-year distribution rules, just an account sitting there, available for qualified medical expenses for his children and potentially his grandchildren. Compare that to what would have happened if David had just accumulated the same amount in a 401k or IRA. His kids would have been forced to drain that account within 10 years under Secure Act rules, triggering a massive tax bill. But because it's an HSA, complete flexibility, complete tax-free access to medical expenses, complete control. Now, I want to address the elephant in the room. What if your heirs don't use the HSA for medical expenses? What if they just want to access the cash? Honestly, that's where the account is least favorable. If your non-spouse beneficiary takes distributions for non-medical expenses, they're going to pay ordinary income tax on those withdrawals. But even then, there's usually a decade or more where they can strategically use the account for legitimate medical expenses and minimize that tax hit. And the IRS is surprisingly generous with what counts as a qualified medical expense. It's not just doctor visits and prescriptions. It includes dental work, vision care, hearing aids, chiropractic care, acupuncture, medical equipment, long-term care insurance premiums, and about 200 other things that most people don't think of as medical expenses. And I had another client, Margaret, in her 70s, who inherited her mother's HSA with a balance of $165,000. Over the next 5 years, Margaret used that account to pay for her dental implants, her husband's hearing aids, her daughter's orthodontia, her own vision correction, physical therapy after a knee surgery, and various supplements her doctor recommended. She barely tapped into the principal and generated zero tax liability. That's the power of the HSA inheritance strategy. Let me give you the final piece: why financial advisors don't talk about this. Most financial advisors make money by managing investments and taking asset under management fees. They don't make money by helping you structure tax-efficient accounts or generational wealth strategies. HSAs aren't sexy. They're not flashy. You won't see them promoted on financial television or in mainstream financial media. But they're absolutely one of the best tools in the tax code if you know how to use them. Here's my action item for you. If you have an HSA and you're not using it as a wealth-building tool, you're leaving money on the table. Max it out. Don't spend the money unless you absolutely have to. Let it grow. And when you're doing your estate planning, talk to your CPA or tax strategist about naming it as part of your generational wealth plan. For your spouse, it's seamless. They inherit it, continue using it, problem solved. For your kids or other heirs, it's a flexible, tax-efficient asset that can provide decades of tax-free medical expense coverage or serve as a secondary inheritance pool. I've seen HSAs grow from overlooked afterthoughts to the centerpiece of sophisticated estate plans. And I've helped clients pass down hundreds of thousands of dollars in tax-free wealth to their families. 1 year of HSA contributions at a time. The tax code rewards those who know it. Keep learning. The research is clear. HSA, when properly structured with spousal beneficiary designations and supported by documentation of medical expenses, represent one of the most underutilized tax-advantaged wealth transfer vehicles in the tax code. The $8,300 annual contribution limit grows tax-deferred and can pass to a surviving spouse entirely tax-free, maintaining that tax deferral benefit indefinitely. Non-spousal beneficiaries retain access for medical expenses without taxation, and the income taxation only applies to non-medical withdrawals. Compare this to 401(k)s, which face 10-year depletion rules and forced income taxation for non-spouse benefits.